The broader crypto market is facing heavy selling pressure today, but inside the PLAZM protocol, the mechanics are operating exactly as designed, absorbing capital and compounding yield despite the external conditions. For day 172, we are looking at a correlated market pullback. Both PLAZM and eSHARE token prices are down roughly 5.5%. However, the internal protocol metrics are moving in the opposite direction. This split-screen dashboard shows the exact divergence. On the left, price is down. On the right, the protocol crossed 12,011 active bonds. The APR increased past 42. They tracked downward in lockstep parallel, dropping from yesterday's highs to close down just over 5%. When two paired tokens decline with this level of correlation, the selling pressure is systemic to the wider crypto market. If a structural flaw existed within PLAZM itself, these two assets would diverge. The data points to a broader market sell-off, not an internal protocol failure. To confirm the protocol's stability, we check the backing. The central vault currently holds 219.25 Ethereum, maintaining a secure floor of over $470,000 in underlying collateral. These dials show the day-over-day growth in the protocol's yield engine. The system added 19 new bonds in the last 24 hours, bringing the total to 12,011. Each new bond increases the protocol's daily yield generation. When token prices dip while bond counts rise, the mathematical result is an immediate optimization for existing holders. The yield percentage relative to the token price naturally increases, which is why the APR jumped 46 basis points today. Today, the buy-burn-build system, the protocol's automated treasury management mechanism, deployed $440. That capital was actively used to buy PLAZM off the open market and permanently remove it from circulation. While the lifetime historical spend of this system has reached over $68,000, that metric only shows past performance. The actual current reserves available to deploy are shown in the buy pool. These gauges show exactly how much capital is ready to deploy. Despite the red market day, the deployable buy pool jumped to $3,550. Simultaneously, the buy and grow function is compounding the treasury at a rate of 2.77 bonds per day. This pie chart tracks the 9.3 million token supply. With 19% permanently burned and 24% staked, 43% is entirely removed from liquid circulation. Another 16% sits in liquidity provider positions to facilitate decentralized trading. This 7-day forecast shows near zero scheduled unlocks. A minor $65 release on day 174 is followed by completely flat days. Because this equals less than 2 hours of daily burn capacity, the automated treasury will absorb it with zero friction. By continuously growing the deployable buy pools while facing a completely empty short-term token release schedule, the protocol has mathematically isolated itself against internal sell pressure. The day 172 data is definitive. External market forces dictated red candles on the charts, but the internal mechanics, bond growth, APR expansion, and treasury reserves are entirely green. This summary matrix indicates that the 80-day forward outlook is completely clear of major token unlock cliffs. With growing daily yields and minimal scheduled sell pressure, the protocol is actively operating in accumulation territory. Daily fluctuations in USD value are a normal part of holding highly volatile crypto assets. Base your evaluations on the verifiable data of the underlying engine. Do your own research, and remember that nothing here is financial advice. We will track the metrics again on day 173.